Palantir's current price-to-sales (PS) ratio sits at roughly 104 times, meaning investors pay $104 for every $1 of revenue. By comparison, mature software peers like Microsoft trade at around 10 times sales. Meanwhile, its forward price-to-earnings (PE) ratio of 224 times implies nearly 18 years of future profits are already baked in to today's price levels, which, in historical context, have often preceded market corrections. To put this in perspective, imagine buying a theater ticket today that promises front-row seats to every Broadway show for the next 2 decades, all for the price of a latte. That's essentially Palantir's proposition: pay now for years of anticipated growth, with little margin for error. Why overvalued may be an understatement. Historical norms versus Palantir's multiples. PE ratio. Historically, a fairly valued PE hovers around 20 times, Palantir's 200 times price tags it as a supernova, exceedingly rare and, some would argue, unsustainable. PS ratio. Anything above 10 times is considered steep in software. Palantir's 104 times eclipses even the frothiest valuations of the dot-com era. Revenue growth versus valuation. Yes, Palantir delivered 29% revenue growth in FY 2024, $2.87 billion, and forecasts 39% growth in Q1 2025. But to justify a 104 times sales multiple, the company must sustain 50-60% plus annual growth for years, no small feat, even for AI darlings. Risk of a day of reckoning, such extremes often reverse. Business Insider noted Palantir's stock dipped 15% after Q1 2025 earnings, despite beating revenue forecasts, proof that lofty multipliers can become a double-edged sword. If future quarters don't exceed sky-high expectations, analysts warn, the stock could face sharp corrections. When giants reach for the stars, Palantir versus peers. Despite leading in AI integration for defense and enterprise, Palantir's valuations tower over both established giants like Microsoft and high-growth pure plays like Snowflake. Betting on a breakout here is akin to wagering your life savings on a single horse, one with dazzling past victories, but a steep track ahead. The $1 billion buyback, a vote of confidence. In August 2023, Palantir unveiled its first-ever share repurchase program, authorizing up to $1 billion in open market buybacks. CEO Alex Karp framed it as a signal of long-term confidence and a way to reduce share count, an implicit nod to the board's belief that the stock was undervalued. Free cash flow, FCF, fuel, FY 2023 adjusted FCF, $730.5 million, 33% of revenue. Q1 2025 adjusted FCF, $370 million, 42% margin. With such cash on hand, the board's logic was clear: if we've borrowed enough lattes in the cell block of Wall Street's cafe, let's buy back shares at a bargain, $25 to $30 range, even if other areas, like marketing or R&D, beckoned. By the way, if you are benefiting from the content so far and want more like this, hit the subscribe button, turn on the notifications bell, and comment the word more. Just go ahead and type the word more so I know. Now that you've commented, let's continue. But wait. If you are interested in stock news updates that might be relevant to your financial targets, join us and become a member for member-only videos. Find the link in the description section below. Recent completion and impact. By February 18, 2025, Palantir had repurchased 2.33 million shares for $82.2 million, completing the first tranche under the program. Though modest relative to the $1 billion authorization, this action absorbed excess float and drew applause from investors caught off guard by the company's earlier inaction. Market reaction: short-term boost of 2 to 3% in share price post-announcement, signal that management isn't simply talking. Cash flows underpin real buybacks. Future capital allocation and catalysts. Potential for additional buybacks. Management has $918 million still available under the original authorization as of Q1 2025. With FCF margins greater than 40% in recent quarters, another tranche could arrive once share prices dip into the mid-$100s, offering a buying opportunity for the board's taste buds. Dividend initiation. While Palantir has never paid a dividend, a future payout could materialize when FCF consistently exceeds capital reinvestment needs. Management's own guidance possibly targets $800 million to $1 billion in FCF for 2025. Imagine Palantir sending investors a quarterly AI bonus, a literal token of the data analytics magic at work. In true Palantir style, expect CFO Dave Glazer to quip, "We're flush with cash. Would you prefer shares back or a placard in your office proclaiming, 'I held PLTR and got paid'?" Investors ready for a chuckle and a check should keep an eye on the buyback ticker. Palantir stands at a crossroads. Lofty valuation versus prodigious cash flow. Its 104 times P/S and 224 times forward PE ratios pose a high-wire act for investors, yet management's $1 billion buyback, successful initial tranche, and hefty FCF margins offer tangible confidence signals. Key catalysts to monitor include additional buyback tranches, watch for SEC filings showing further share repurchases, dividend announcement. Any shift in policy toward payouts would mark a maturity milestone. Revenue growth versus expectations. Can Palantir sustain 40% plus growth to justify its multiples? Macroeconomic shifts, AI enthusiasm wanes or interest rates rise, and the valuation tether could snap. In sum, Palantir's story reads like a high-stakes saga. One moment it's the hero of big data warfare, the next it teeters atop vast expectations. Whether the stock's next chapter features more buybacks, dividends, or a reality check remains to be seen, so buckle up and keep your popcorn and spreadsheets handy. Palantir's valuation continues to far outpace both its historical norms and high-growth peers, with current multiples implying nearly 2 decades of future earnings already priced in. Fundamental models suggest the company would need to sustain 30 to 40% annual revenue growth and expand free cash flow margins significantly to justify today's share price. While its first $1 billion buyback and robust FCF generation underscore management's confidence, recent share repurchase activity has been modest relative to the authorization, and the stock remains vulnerable to any slowdown in AI spending or lumpy government contract timing. Looking ahead, additional buybacks, a potential dividend, and execution on commercial scale-ups could serve as catalysts, but investors should weigh these against competitive pressures, valuation re-rating risk, and the high bar already set by the market. Despite impressive 65% growth in commercial deal counts, large-scale enterprise adoption remains in early inning. Winning multi-$100 million deals against entrenched incumbents like AWS, Google Cloud, and Snowflake will require both aggressive pricing and flawless execution, a steep hill to climb. AI hype cycle and competition. The broader AI market may see waves of boom and bust as enthusiasm oscillates. Pure-play AI specialists and boutique startups could undercut Palantir on emerging niche solutions, fragmenting the market and pressuring margins. If Palantir continues to demonstrate 80+% net revenue retention, driven by add-on modules and expanding seat counts, it could justify a premium multiple akin to Snowflake's 55 times PS, larger. Multi-year commercial agreements could lock in growth visibility well into the late 2020s. AI catalyst. Wedbush's Dan Ives argues that surging AI budgets could position Palantir as a next-generation Oracle in data orchestration, potentially tripling its addressable market to over $50 billion by 2027. Meeting or exceeding these AI-driven expectations could propel shares even higher, with roughly $918 million still available under the August 2023 authorization. Palantir could accelerate buybacks if shares dip below intrinsic value estimates, e.g., $100 to $120. A surprise dividend initiation, once FCF surpasses reinvestment needs, would signal maturity and could attract income-focused investors. It's our privilege that God, the creator of heaven and earth, will bless us abundantly, make us the head and not the tail if we love him and obey his commandments. Please acknowledge him in your plans and he will direct your paths. Proverbs 3 verses 5 to 6. Want more information? Please check the description section. Also again, if you are interested in more relevant stock news updates, consider becoming a member. Link in the description section. If you have watched until the end, drop a comment like this: "I stayed until the end." Just comment that I stayed until the end. When I see this comment, I will give you a heart. There are 3 more important steps to build wealth. First, like this video, subscribe and then turn on the notifications bell. If you do this, you highly motivate me to continue bringing to you educative and transformative videos every week. Do not miss out on our future videos full of knowledge and wisdom. All I am asking is your subscription. Thanks for joining us today. Your support is appreciated so much. Do not hesitate to share this video to help someone. I recommend that you watch the next video, subscribe to the channel and share your thoughts about today's video. Thank you. See you in the next video by God's grace. We love you, and blessings to you.